The first objective in trading is to protect your capital, while the second is to gradually increase it, using a strategy based on compound interest. As in a football match, you have to know when and how to attack, and when and how to defend. Knowing how to attack allows you to progress and increase your capital, while knowing how to defend allows you to protect your results. They both have the same level of importance. Risk management is primarily based on defense. According to statistics, 90% of people lose money in trading because risk is not managed correctly. Many people treat trading like gambling, and risk all of their capital in the hope of quickly doubling it. Initially, it is advisable to risk between 0.5 and 1% per trade, and then increase, after a minimum of 6 consistent months of profit, to a maximum risk of 2%. Professional traders risk no more than 2% of their capital per trade, and properly manage the size and leverage of their positions. All traders face negative streaks, and it is in these situations where risk management becomes fundamental to implement. If you risk 10% for each trade, it means that with 10 trades you will lose all of your capital. Instead, if you risk 1% per trade, after 10 negative trades, you will still have 90% of the capital available. The stop loss is a vital tool that must be set for each trade. Unexpected economic and political news can move the market against your own analysis, and in many cases your mind will not be ready to accept the closure of the trade. The mind will wait and hope for a reversal, which in 95% of cases will not happen, and the loss will increase accordingly. In a risk management strategy, it is important to protect positions in profit by moving the stop loss to the entry price, or in some cases, even moving the stop loss into profit. A good risk management strategy is based on calculating the probability of your system, calculating the risk-reward ratio, and being disciplined to follow a fixed percentage of risk for each trade. The first important step in becoming an independent trader is to have a broad knowledge of the mechanisms that move the Forex market, and to create a system that best reflects your goals and personality. The second phase that will allow you to learn even more will be thanks to the experience that you will acquire by learning from your mistakes. Mistakes can be technical, but initially they will mainly be related to incorrect risk management, opening positions that are too large for your capital, and treating trading as gambling. This is because many traders start with a minimum capital, and try to gamble in the hope of making it grow fast. The first advice is to train and test your strategy on a demo account, for a minimum of 1 month up to a maximum of 3 months, and be able to be consistently profitable, maintaining proper risk management, even if it is virtual money. Once you manage to be profitable with a certain strategy, you can switch to a real account by opening positions with micro lots. Starting to invest with a real account will make various emotions emerge, that must be controlled and managed, such as fear, greed, hope and anger. 90% of success lies in psychological balance and discipline. A written strategy for risk management is essential to remove negative emotions and temptations, which can be detrimental for new traders. Success in trading means being profitable over a long period of time. The true measure of a trader's success lies in repeatability. 3 fundamental concepts to always keep in mind are: always have a higher reward than risk on each trade. Never lose more than the percentage set for your trade. Use a compound interest strategy to gradually grow your capital. The success of a trader lies in the ability to identify a valid entry and exit strategy. We must always be clear about the percentage that we will risk, and at the same time we must have discipline in respecting it. Emotions are not allowed in this business. Follow your strategy, and always be realistic about your expectations. Trading is a real entrepreneurial activity, where your trading capital becomes your company. Discipline is one of the most important factors that will help you become a successful trader. When you start off your trading journey, it is not easy to trade with a small capital, and you certainly need a lot of discipline in order to do so. By trading with a small capital, you are basically obligated to focus exclusively on your performance, and not on money. If you focus solely on money, you will end up blowing your account. Beginners should all have a small account, and practice as much as they can, in order to gain a lot of experience. Beginners should focus on learning and practicing. They should not be obsessed with money. Traders need to work on gaining as much experience and confidence as possible, because it is very important for their trading success. To learn and gain experience, you will need to make lots of mistakes. It is completely normal, and you want to do that with less money as possible. If you want to become a successful trader, you need to focus on learning. Money will come automatically when you develop your edge. So many traders never give themselves the proper chance of success, because they are so obsessed about making money immediately. There is so much time to make money in the financial markets. You need to be patient. When you have a good rational trading system, you don't need to be in a hurry, you need to be confident to execute the trade when the opportunity is presented. It costs $0 to wait for the right opportunity, but it will cost a lot of money to enter a trade based upon your current emotional state. Most psychological issues come from a lack of correct position sizing, and the need to always be active in the market. Once you understand that you need to be disciplined in your position sizing, and compound your capital month after month, as well as understanding that not every day is trading day, you will start seeing enormous positive results. These two factors are essential to become a professional trader. You must be disciplined to execute trades that follow your system strictly. If you become too emotionally attached to a specific trade, it means that you need to reduce your position sizing and trading capital, to the point that there are no emotions involved. You need to find a balance between unemotional attachment and enough money to still feel motivated. Take advantage of opportunities using a well-written rational trading plan, and be disciplined to understand when to add positions, when to lock in profits, and when to cut losses. In trading, whoever has a strict system, fixed patterns and standards to observe, will eventually succeed in the market. After each trade, you must always be able to answer the question: why did I open the trade? How did I manage the trade? How did I exit from the trade? You must always be honest with yourself when answering these questions. If you fail to lock in profits, it is because you were doing something wrong, and not because you were unlucky. It is very important to always stay open-minded, while adapting to market movements, and never get attached to a single trade. The market always changes, and you must never get overconfident, and think that you are smarter than the market. Trading is not gambling. We are not playing. We are investing our hard-earned money with probabilities, statistics and macroeconomic analysis. Having a consistent trading journal is an aspect that should not be overlooked, especially after losses. The best lessons are learned after losses. After winning trades, we need to analyze how the trade was managed, if it was closed too soon, if the risk management was correct, and how we behaved emotionally. After losing trades, you need to analyze why the price did not respect your analysis, analyze if you entered the market too early, if the risk management was correct, and if there were fundamental news that impacted the asset. You will learn much more from losses than from wins. Experience beats education, and in the long term it will give you the edge and intuition to profit in certain situations. Always keep track of your trades, analyze your performance, your attitudes, your emotions, and understand what you need to improve. Creating a daily journal using a notebook or on your computer is a great way to improve your trading performance. We also suggest you to take a before and after picture of your trades, to keep in mind market situations that should and should not be repeated. This process will drastically help you in your growth as a successful trader. Averaging down is when a trader buys an asset, but the price falls, and the trader decides to buy again despite being at a loss. This obviously also applies to traders who continue to sell, despite the fact that the price continues to rise. Averaging down, therefore, represents the action of opening further positions, despite the price going against the initial analysis, in the hope of recovering quickly and returning into profit. Averaging down is a type of strategy that works well for long-term investors, because the price of the assets has time to go back up, or down, based on the open trade. Professional traders who are based on the long term, and who apply this strategy, use a very low leverage, and positions are calculated very strictly, to manage efficiently their capital. This technique is also used by banks, having in fact a long-term approach, and above all having the power to change the direction of the price, thanks to their high liquidity. For all traders who instead rely on the short term, averaging down represents a risk that will cost time and money. It will cost time because the time used in opening further positions on a negative trade, and with a hope of recovering, will not allow to analyze other currency pairs, to find potential new opportunities that could generate a higher return. It will cost money because by opening further positions on a negative trade, you will risk accumulating a greater loss, and consequently risking a high percentage of your capital, without even trying to diversify your portfolio. In certain situations, instead of opening further positions in the hope that losses can be recovered, it is better to close the initial trade, and wait for the right moment to re-enter the market. This video was included in the psychology section, because averaging down, for most traders, is caused by a lack of emotional control. Emotions such as anger, arrogance, and hope lead traders, especially beginners, to open multiple positions with incorrect risk management, trying to make the big deal by recovering their losses. Unfortunately, this will most of the time cause considerable losses, which can damage the available capital. The best time to open further positions is when the trade is in profit and is following the analyzed direction. Price corrections are a great time to enter the market and add more positions using a proper risk management. You can enter the market when you have a retest of support or of resistance combined with other confluences, such as key levels and Fibonacci levels.